process, and we're going to be looking at an example. Now, earlier we discussed about a bank which generated some mortgages, right? Originated some mortgages, and then it made a special purpose vehicle to securitize those mortgages. And this is an example of an asset-backed security, which is a mortgage-backed security because the asset in this particular case is a pool of mortgages. So hence this is a mortgage-backed security. But what if it was not mortgages, right? What if it was not a mortgage-backed security? Instead of, let's say, a bank, let's say it is an automobile manufacturer, and instead of mortgages it is auto loans, right? And this automobile manufacturer helps people buy cars or automobiles from them by facilitating this financing process, this leasing process, that you can get a car on a 5-year loan. But the problem is the automobile manufacturer has a limited amount of finance. So once it uses all the money that it has to give out these loans, now what it would like to do is securitize those loans, right? And create asset-backed securities. They won't be mortgage-backed securities because obviously we're not dealing in mortgages right now. These will be backed by auto loans, but they will want to get investors to invest in these securities because then they can earn a good return on it, and the people who are buying these cars on loans will be making the payments, right? And those payments will then be passed on to the investors. And then the automobile company can get their lump sum payment now, and then they can use that to originate more loans and sell more cars. So this is a very helpful thing to do for the automobile manufacturer to continue to grow their business. And that's exactly the example we're going to look at right now. Kantara is a manufacturing company of automobiles. It's a manufacturer of automobiles. They're selling cars between, let's say, $20,000 to $200,000, and majority of the sales are made through loans. Now, they've been giving out these loans for 5 years, and what has happened is that 100 million worth of loans are there, and they don't have much more capacity to keep giving these loans. So they need to raise some money, right? And one of the ways for Kantara to do that is by taking these loans, these auto loans, right, and transferring that ownership to an SPV, and that SPV in this case is Automobile Trust. So the name of the SPV is Automobile Trust, and they transfer the ownership of the auto loans to the Automobile Trust, and then the Automobile Trust can issue the securities, asset-backed securities, right? So this is what's going on in this example. One thing I just want to emphasize on is the concept of bankruptcy remote. Now, what does that mean? Bankruptcy remote. See, if, let's say, Kantara goes bankrupt for whatever reason, right? They're not able to sell more cars, they go bankrupt. Now, these investors who have bought these securities have nothing to do with Kantara anymore. They've just got a relationship with these people who've bought the cars earlier and are going to be paying back the loans, right? So even if the original seller, the original issuer, the original originator goes bankrupt, it makes no difference to the SPV because the SPV already has its assets, right? That it is using to pay back the investors. So that's why this SPV is bankruptcy remote. And therefore, what could happen is that even if Kantara, let's say, had a lower credit rating, like a triple B or a double B or a B, right? It had a lower credit rating, and these loans are very good because these people who've taken these loans have very good jobs, and the collateral, which is the car itself, is also very good. It has a good resale value. So these securities can actually get a better rating than Kantara's original rating as a company. So this process of securitization actually creates an opportunity for getting a better credit rating for the securities, the asset-backed securities, as long as the asset is good quality, right? The rating depends on the asset. The rating of the securities, the rating of the asset-backed securities depends on the quality of the asset that is backing them. And it has nothing to do with the original issuer because this SPV is bankruptcy remote, right? And that is what is being explained over here. That when you make a separate legal entity, the SPV, it is considered bankruptcy remote because even if the original issuer goes bankrupt, it makes no difference to the SPE and the investors because they have their own asset, right, under their control. And that is very, very helpful in getting a good credit rating for the asset-backed securities. It will have a separate credit rating than the original issuer. So what's going on? What's the entire process? Number one is the origination of the loans, right? So this is the origination. Then here is the distribution. So this is the originate to distribute model where the loans are being given off to the SPV or SPE, special purpose vehicle, special purpose entity, and they are giving the payment to Kantara, right? So that's the originate to distribute model, that Kantara has originated these loans and distributed it. Now the process of securitization is there, right? So this is the securitization where the securities are being issued and sold, right? Then the cash payment is coming in, and then the periodic cash payments are being made, right, by the customers and then to the investors. So this is the entire process. So who are all the parties here? There's the originator, Kantara. Then there's the SPE that issues the securities. That's your automobile trust, right? Your SPE. And then there's a servicer which doesn't have to be the same as the seller, but it usually is. And it's so nice for the seller to get rid of the risk of those loans, but still stay on board and keep getting a fees for collecting the payments. So it's a very sweet deal for the seller. It could be a very bad deal for the investors if the quality of the loans is very bad, but that's where I think credit rating agencies have a very important role to play, that if they're giving a good credit rating to the asset-backed securities, then they should make sure that the asset is actually good quality, right? So part of the problem in the 2008 financial crisis was that they didn't really do their job properly. These credit rating agencies, they gave very good ratings to these asset-backed securities when they shouldn't have, because the loans, the asset behind those securities were actually not that good. A lot of the borrowers were having no income or no job. So then how were they supposed to pay back? So anyways, I mean, of course, your issuer is there. That can be the servicer as well. But there are other parties involved. There's independent accountants, underwriters, trustees, rating agencies, guarantors, right? Lawyers taking care of the documentation, underwriters that facilitate the bond issuance, rating agencies that rate the securities. This was a big problem in the 2008 financial crisis. They didn't really do a very good job. And of course, there's a trustee that holds those assets in on behalf of the investors. Anyways, so what's going on over here is that in the Kantara example, the SPE, which is your automobile trust, right? That's what was the name of the SPE, right? Automobile trust. It's just issuing one type of security called bond class A. But practically speaking, it doesn't work like that. There are multiple layers or classes issued, right? And so in reality, there's much more layers that are created. So there is different types of structures, and this is done to deal with something called prepayment risk and credit risk, right? And before I tell you about prepayment risk and credit risk, let me tell you about the word that is used for this, and it is called tranching. Now, tranching is just means layering, right? It's a French word for layers. So essentially, what we're doing is layering but the word we use it is for this is tranching, which is just a French fancy word of saying that it is done in layers. So what's going on over here is, let's say you have your Kantara, which is getting rid of these auto loans, and it is giving them to the SPE. Now, the SPE, instead of just selling one type of bond, which is bond class A, what it could do is it could take this and split it into different layers and say, okay, I'll issue bond class A and bond class B and bond class C, right? And what is the advantage of splitting it into different layers? Well, as discussed in the previous slide, it is done for two reasons. One is prepayment risk and the other is credit risk. Now, what is prepayment risk? Prepayment risk is that the borrowers prepay more earlier than expected, or they don't pay on time, right? So first of all, there is a certain natural rate of prepayment. What does that mean? See, I mean, if you're talking about cars, then what happens is that there could be accidents. And if there is an accident, then the insurance claim will be there, and the payment will be made because the loan is just not existent anymore because there's been an accident. Let's say it's a very bad accident and the car is unusable. So what will happen is that there's going to be an insurance claim and the loan will be settled earlier than expected. So there will be a prepayment, right? Some people are just upgrading cars. There's trade-ins, right? So they give in their old car and take a new car. So because of that, they settle the loan earlier than expected, earlier than the schedule, right? And that's for autos. In case of mortgages, what happens is that people sometimes pay their mortgage earlier because maybe they are shifting from one city to another due to work reasons, or maybe they're just shifting into a bigger house or shifting into a smaller house and they need to settle their mortgage. So that's like the natural rate, right? Because this is just natural stuff that people shift. People go into bigger houses or smaller houses, things change. And there is something called the Public Securities Association that has done an analysis on a long period of time, right? They've taken huge amounts of data and they've come up with this natural rate, which they have analyzed over decades. But sometimes what happens is that the prepayments are more. The prepayment rate is faster than the natural rate. And why would that happen? So let's say if the interest rates go down, If the interest rate goes down, then people who've taken mortgages at the higher rates would like to refinance their mortgages at the lower rate, right? Because the interest rate has gone down. And the way they would be able to do it is by making the prepayments so that they settle the existing mortgage, which is at a higher rate, and then they take out a new mortgage at the lower rate. Or similarly, for an automobile loan, what people will want to do is pay it off and then get a new one at a lower rate. So then the high prepayment is there. Now, why is that a risk? Why is that a risk? Because if you're an investor and you are hoping to receive 5% interest on your investment that you've done, and then the interest rate goes down to 3%, then what will happen is that the investors will receive their money back earlier than expected, right? Because the borrowers would not want to pay 5% anymore, so they'll want to prepay this loan, get rid of it, and then issue a new loan at 3%. Now, the investor that was hoping to earn 5%, well, they get their money back earlier. And then when they go out and try to give new loans, what they find is that the new rate in the market is 3%. So that's why prepayment is a risk. It could very well be the other case as well, that the interest rate, instead of coming down, actually goes up, in which case, let's say it goes to 7%. So nobody will want to prepay. They will want to keep their rate locked at 5%, in which case the investors will not only not have a speeding up of the prepayment, rather the prepayments will become slower than the natural rate, right? Because people will not want to pay this loan back early because they've got a lower rate than the market. So that is what we call expansion risk. So prepayment risk can actually be broken up into expansion risk in case interest rates go up, or it could be contraction risk if interest rates go down. So it could prepay, so the entire maturity could contract or it could expand. So what are we talking about? We're talking about the weighted average maturity of this pool, and that pool has a certain weighted average maturity, and its weighted average life can be different, right? So initially you thought the maturity was, let's say, 5 years, but then because of interest rate going down, the weighted average life becomes 3 years. There's a lot of prepayment, so there is a contraction risk. Or if interest rate goes up and the weighted average life becomes 7 years, more than 5 years, then there is an expansion risk. So that is one of the reasons why they do layering. What layering will do, or tranching will do, is that if there is any prepayment, so if there is any contraction, right, if there is any contraction, what will happen is that this junior tranche, it's called the support tranche, by the way, in the case of your time tranching. And when we are talking about the solution for prepayment, we are dealing with something called time tranching, where any kind of contraction or expansion is going to be given to the support tranche, which is the junior one, and the senior tranche, which we call the pack tranche, right? So the senior one is called the pack tranche, and the junior one is called the support tranche. And the pack tranche basically doesn't get any extension or contraction, so their weighted average life is very stable, right? Maybe if it's 5 years, so then it stays around 5 years. But with the support tranche, the weighted average life can fall to maybe 1 year and rise to maybe 7 years. So it is a lot more volatile, right? There could be severe contraction that they get their money back within a year, or severe expansion that it could go up to 7 years. So a lot more volatility in your pack tranche, in your support tranche. Now, the other thing I want to talk about is credit risk, right? So what could happen is that there could be default, right? There could be default and people might not pay at all. So here we don't do time tranching, we do something called credit tranching. And here we don't have a pack tranche and a support tranche. What we have is a senior tranche, right, and then you have your junior and then subordinated. There will be subordinated tranche, there will be a junior one, right? Junior. You can even call it, the last one you can call an equity tranche, because it's going to get what's remaining, right? Just like your equity. So here, if there is any default, what will happen is that these guys will lose money first, the equity tranche, and the senior tranche is safe from default relatively, right? So they're the last ones to lose money. So this is again creating layers, but not for the purpose of managing the prepayment risk, which is what we do time tranching for, but this layering, the credit tranching or the credit layering is done to manage the default risk, right? So what is prepayment risk? It's the uncertainty that the actual cash flows will be different from the scheduled ones, right? And it depends on the interest rate movement. So if interest rate goes down, then people will want to get it refinanced. So what you have is something called contraction risk, right? If interest rates are going down, what you have is contraction risk, and weighted average life will go down. Whereas if your interest rate goes up, people will want to keep their existing mortgages, right? So what you have is expansion risk. And your weighted average life will then be greater than your original weighted average maturity. Now, prepayment risk cannot be eliminated. It can only be redistributed, which means you can have your pack tranche and your support tranche. So you can protect the pack tranche and let the support tranche take all that contraction and expansion. But somebody is going to have to take it. It cannot be eliminated, right? So if interest rates go down, people want to prepay, and if they want to prepay, then obviously we will have to have the support tranche to take that hit. And this is called time tranching, right? This is called time tranching, and we just talked about it. So you can have 4 layers here, where if there is prepayment, then the A4 people get it, right? And next is credit tranching. So this is to take care of the credit risk or the default risk. Again, similar concepts, that there is a senior tranche and a subordinated one. And if there is any default, then the subordinated ones take the hit first before the senior tranche loses money. Right, so here you've got A, B, and C, and then the risk is obviously highest for C and lowest for A. Right, now coming to the role of the SPE, and as I have already explained to you, that the SPE is bankruptcy remote, right? Which means because the ownership of the pool is transferred to the SPE and it is issuing the securities based on this asset backing them. So even if this original issuer goes bankrupt, it doesn't make any difference because the SPE is bankruptcy remote, right? And if this pool, the assets in this pool are very good, that the borrowers have good jobs, they have good incomes, right? So they have a good ability to pay back. Also, the cars that they have are available as collateral, right? So, and they have good resale values. So then the securities can maybe get a very high credit rating, even though the original issuer maybe has a lower credit rating. So this is the role of the SPE. That it can actually, the bond classes can actually have better credit ratings than the company itself, right? So that's why it doesn't make sense for the issuer or the original company to issue corporate bonds if Kantara issued bonds themselves instead of making the SPE and doing the securitization. If instead of doing that, if they didn't do it, if they just issued bonds themselves to raise finance, well, if Kantara has like a double B rating, then these bonds will also have a double B rating, right? Now you might be thinking, but can't you just say that they are secured bonds and you could give that same collateral, the cars and the loans, as the security? Well, that's true, but there is some complexity over there which we're going to discuss, that why it's not as good as doing the securitization separately. So let me show you the entire scenario. One in which Kantara issues a corporate bond versus another one where we do the securitization as discussed. Now, if Kantara issues the corporate bond, and let's say Kantara's own credit rating as a company is double B, the bond will also receive this credit rating, right? Why? Because even though it is going to be linked to the collateral, but it is also going to take input from the actual credit rating of the company. And why is that? I'll just explain to you why that is. But let me just remind you that what did we talk about? The corporate family rating, and then the notch up and the notch down. So even if the corporate family is double B, I mean, maximum what you can probably get is maybe triple B, right, as a notch up. But you won't be able to get double A or A unless you completely make it a separate SPE. And the reason for that is why it's so hard to pull away from the corporate family. So what happens is the problem here is, in reality, the absolute the concept is that if this company is separately giving you its assets, that it's saying that, okay, this bond is secured by this collateral, right? And therefore, in case of liquidation, you should use this collateral to settle this bond. It sounds very nice, right? But practically speaking, what happens is, when a company does go bankrupt and there is an administrator appointed for it, and it goes into liquidation, then the other people who have claims, the unsecured bonds, right, the other liability holders, maybe you will have some accounts payable, maybe employees have their salaries unpaid. So practically speaking, what happens is that it's a big mess, and it all gets mixed up, and it's a hodgepodge, right? So it's not really that easy to separate these bonds and give them those assets. They all get mixed up. That's why when you're doing a credit rating for a separate issue, you cannot deviate too much from the corporate family rating. So max you will go a notch up or two notches up, but it's not going to be something completely different, right? That's why it makes more sense. That's why it makes more sense for you to just, instead of doing the corporate bond, which will obviously have higher risk and will have to pay higher return, and the credit spread will be higher as well, right? It just makes more sense to, instead of doing this, to go for your securitization scenario, in which case you can have a completely different credit rating, right? Because the SPV is bankruptcy remote. It has nothing to do with the original issuer. You just take the assets, you take the pool of assets, and you make a completely separate company, and it will have a completely separate credit rating, nothing to do with the credit rating of the original company. So I hope you get that point. Right. Yeah, here it is. Look, the absolute priority rule is followed. If the company goes bankrupt, the absolute priority rule is followed because it is the SPV is separate. But if it was one company, then the absolute priority rule will not be followed to the letter. Absolute priority rule will not be followed perfectly, because it just becomes a big hodgepodge, there are other creditors as well, and then the administrator has to kind of be fair with everyone. So it's just better to have a completely separate SPE, in which case the absolute priority rule will be followed, and therefore you can have a very, very nice rating for the security and pay a lower return for it because the risk is lower. Right. Unfortunately, this whole bankruptcy remote concept was misused in the global financial crisis. How? So the bank said, okay, here's the pool of mortgages, transferred it to the SPE. SPE issued the securities, and the credit rating agencies gave them a very good credit rating, which enabled the SPE to sell these securities to pension funds and insurance companies who have low risk appetite. But the pool was actually just really bad. It was subprime, right? So a very bad mistake by the credit rating agencies to give these securities a high credit rating. And bankruptcy remote works both ways, right? Because, for example, if the SPV is bankruptcy remote, which means if the bank goes down, it makes no difference to the SPE because they have their asset under their control, which is very good. But the exact opposite could happen as well, where instead of the bank going down, what if this pool goes down, right? And the bank is also bankruptcy remote, which means if the pool goes down and the SPE goes down and the securities go bust, nobody can come to the bank because the bank doesn't have that responsibility, right? So this whole bankruptcy remote concept was actually misused back in 2008 in the global financial crisis. Now what we have is that we don't let the bank get away that easily. They still have a relationship and they have to replace assets in this bond, and that's where your covered bonds come in. So that of course is not discussed in detail in this particular learning module, but since we're on the topic, so I thought that it's appropriate for me to actually give you the bigger picture in terms of bankruptcy remote, that yes, it is definitely very good and it can be used to get high credit rating for these securities, which is a very good thing. But the pool should not be subprime, right? It should be good quality assets, and the bank should be kept in the loop and in connection to that pool in case that the pool doesn't perform. Because I mean, if you just let the bank off the hook, then they're just going to originate garbage, right? So this is the big picture over here. So the SPV is bankruptcy remote, and we already know all of this, right? So you are probably an expert of securitization by now. Right, guys, so what did we discuss in this learning module? We talked about benefits to investors. They get access to an asset class which traditionally they have not had, right? Such as mortgages, and you'd be surprised the type of assets we have in asset-backed securities. So we have credit card, debt, loan pools, we have auto loans, we have corporate loans, right? And it's very interesting for investors like pension funds and insurance companies to be able to invest in pools of auto loans or credit cards or corporate loans. So it's definitely a very good innovation, but needs to be fine-tuned, and it is being fine-tuned, has been since the 2008 financial crisis. It's good for the bank, right? Good for the bank because they can go on and originate more loans, so they can liquidate their existing ones, and they stay on board as a servicer, so they keep getting that fee. So that's fantastic for them as well. It's good for the borrowers. The borrowers get such a whole new type of investors, which then obviously increases the amount of investment available for them, and this entire securitization process reduces the risk as well, because the entire diversification benefit is there, because the pool is so massive and so many different borrowers are there. So the investor gets a complete diversified pool and gets to share that risk with other investors, and the security is liquid, so they can easily exit when they want as well. So it's overall it's very good for the efficiency of the financial system. The only thing is that you need to make sure that the bank is tied to the performance of the loan, right? You don't let them off the hook. Otherwise, they will originate very, very bad loans, and then garbage in is, of course, garbage out. Right. What did we talk about? SPEs, they are bankruptcy remote, and you can call them the trust or the issuer. The seller is the original originator, right? The bank or Kantara, which is the automobile company, whoever has originated the securities. Servicer usually is the seller as well. Doesn't have to be, but usually it is. They stay on board because they have that relationship with the borrower, so they stay on board and collect the payments and charge a fees for it, right? There are a lot of other parties: accountants, underwriters, trustees, rating agencies, and guarantors. And then the entire concept of tranching comes in, where you have time tranching for the prepayment risk and credit tranching for the credit risk. And in your time tranching, you have your pack tranche and your support tranche, right? Support tranche obviously takes that very volatile weighted average mature life going up to, let's say, 7 years or 1 year in our example, whereas your pack has that stable weighted average life of 5, which is equal to its weighted average maturity as expected. So your original weighted average maturity could have been 5 years, right? But your support might go up to expand to 7 or contract to 1. So there's obviously expansion risk and contraction risk there. And as far as the credit risk is concerned, you have credit tranching, where you can have layers in terms of subordination. So your senior one will lose money the last, and your equity tranche, the junior most tranche, will be the first to lose money if there is a default in the pool.